My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you some money. My job, not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Themes propel earnings. Earnings propel stocks. Oh, we see that every day, including this one. Dow dipped 28 points. S&P declined 0.11%. Nasdaq edged down 0.07%. Now, while it may be hard to predict politics or interest rates or current events, it's a lot easier to bet on great themes if you want to make great money. This morning on Squawk on the Street, we had the great privilege to interview Dave Cote. He's the former CEO of Honeywell, who's now the executive chairman of a company called Vertiv. You probably don't know Vertiv. It's a data center hardware play that's merging with GS Holdings. That's a special purpose acquisition company, or SPAC, run by Cote. Now, this guy's a phenomenal manager. He consistently crushed the S&P 500 when he was running Honeywell. But when he retired and turned the reins over to Darius Adamczyk, many people thought, well, he might be done running business. I was thinking he might be. No, not for Cote. You see, it's simply too much fun. He likes business too much, so he didn't quit. He raised some money, looked around for a business that seemed to have the wind at its back, a business that's growing much faster than the broader U.S. economy, a business that's not hostage to global trade or politics or the Federal Reserve. He came up with the data center. In particular, data centers that can deliver digital information at lightning speeds, cut down latency, from what's known as the edge, the outer portion of the network. From there, Cote looked for a data center equipment play that was putting itself up for sale. That was his reasoning, that was his path, and that's how he found Vertiv. Now, why was Dave interested in this particular company? Was the business a fantastic enterprise? Well, he'd probably be the first to tell you no, not yet. And he brought in a fellow named Rob Johnson, who's from the sector, to take over as CEO. Dave compared it, when I asked him about it, to Honeywell a couple of years into the turnaround that he'd led. Dave was confident that Vertiv could only be a platform for spectacular growth. Over the years, I have learned a tremendous amount about business from Dave Cote. For example, one thing he always liked about Honeywell was its aerospace business. Aerospace grows faster than most industries, and the long-term secular growth of the industry is levered to a powerful trend: the middle classification of the developing world. Simply put, most people have never even set foot on an airplane, but over time, more and more of them can afford to fly. Dave says the data center is even better. He thinks that the data center traffic could grow at a 21% clip for multiple years. He sees the volume increasing exponentially, especially when you consider that 90% of all data in history has been created over the past 2 years. By 2025, there should be something like 6 billion mobile users and 75 billion Internet of Things-enabled devices. That's up from 23 billion last year. That's a pretty powerful secular trend, right? Now, is Vertiv a can't-miss proposition? There's no such thing as can't miss. But it sure seems to have a better shot at succeeding than most businesses. I like to crib from the methodical and the rigorous. That's Cote. That's Vertiv. We're always searching for powerful secular themes like this kind of name, themes that work regardless of the macro situation, and they tend to pop up in some really crazy, nutty places. So you always got to be ready to pounce the moment you find them. For example, in last week's game plan, I don't know if you remember, but I told you to buy some AutoZone, AZO, because I expected a strong quarter. And today, the stock exploded higher, up 7%. Did I recommend it because AutoZone is the best retailer in the world? Of course not. I pounded the table because it's the best-run auto parts chain. And the average car on the road is now 12 years old, which means it needs a ton of maintenance. The best way to take care of an aging car? You do it yourself. AutoZone's the best do-it-yourself retailer with an incredibly consistent track record. Is that enough? In an era where almost anything can be crushed by online competition, you need more than a good track record. In particular, you need convenience, and you need the lowest price, which is what AutoZone can give you with its huge selection of cheaper private label car parts. I mean, do you really care what name's on it? My favorite thing about AutoZone, though, just like Dave Cote believes in himself and his business, first with Honeywell and now Vertiv, AutoZone's chairman and CEO Bill Rhodes puts his money where his mouth is. That's why the company bought back $450 million worth of stock over the past quarter. AutoZone has been one of the most voracious repurchasers of its own stock. They still got $1.3 billion left in their current authorization. Now, yesterday I talked about destructive buybacks. Remember, I really zeroed in on retail. I said that both Macy's and Kohl's have spent billions buying back declining stocks, effectively setting their money on fire. The difference between a foolish buyback like Macy's and a smart buyback like AutoZone, it's like any other stock purchase. You have to ask yourself if the shares are actually worth buying. AutoZone's a low-price retailer that's riding a powerful secular theme. Its buyback turned out to be it's just, I don't want to really use the term no-brainer, but you get what I mean. And that's why the stock soared so much today. It was the biggest gain in the S&P 500. Again, we're looking for secular themes, and do-it-yourself auto fits the bill perfectly. Let me give you one more, one that I want you to remember if there's no trade deal with China this weekend, and that is 5G. This quarter, we've seen explosive growth in the 5G wireless cohort. This is the first inning. Now, I point that out because a lot of times you're like, oh, we're only in the third inning, only the fourth. Nuh-uh. First inning. We know there's a lot riding on 5G. We've got a prospective merger in this country between T-Mobile and Sprint. That'd be fantastic for shareholders, although a bunch of states' attorney general oppose it on antitrust grounds, because it would be a 4-3 deal. T-Mobile and Sprint say it will result in better prices for consumers. More importantly, it allows them to spend more on 5G. Although historically, when you reduce the number of competitors in an industry from 4 to 3, customers, they end up getting squeezed. You know what? I would argue T-Mobile and Sprint can't really compete with the two titans of wireless, AT&T and Verizon, especially when it comes to 5G build-out, unless they're allowed to merge. Right now, we only have two major players. This deal creates the third. Okay, so we got China trying to assert 5G leadership with its government demanding supremacy. We have the Europeans trying to catch up with companies like Ericsson and Nokia. Basically, 5G is an industry at war with itself. And you know who are the arms merchants? I got 4 of them. Skyworks Solutions, Qorvo, Qualcomm, and Marvell Technologies. I think any one of these stocks is worth investing in for the powerful multi-year theme. You should own one of them. Of course, these companies have a ton of business in China, which means they sink or swim depending on the outcome of the trade talks themselves, not the rumors of the outcome, but the outcome. What matters to me, though, is not the trade talks, but the theme itself. If we don't get a deal, if there are higher tariffs, well, sure, all 4 of the big 5G chip makers will see the stocks go lower. But will that mess with the theme? Will it stop 5G? Absolutely not. Like the data center, like do-it-yourself auto repair, 5G stops for no government. The bottom line, at a time like this, we need big apolitical themes that work no matter what. And the best of them should work for years and years and years. So when these stocks get hit, you buy into weakness because you know they'll be able to make a comeback, as secular growers almost always will. Jerry in Missouri. Jerry.
Hey, Jim, thanks for all you do for us.
Oh, thank you, Joe.
Jim, I'm long on Viacom B, which is now Viacom C. Mm-hmm. My brokerage has transferred all my shares over to Viacom C, and I've watched the share prices plummet for the last several days, but Viacom B shares have been increasing on large volume. So I called my brokerage, and they can't explain why Viacom B is still trading with the volume. Mm-hmm. So I was wondering if you can explain.
Well, we know from David Faber, it is Viacom C. It's the only one we should focus on. I don't know what kind of arbitrage is going on with the B, but Viacom E is it. This stock has been, Viacom C, the stock's been terrible. My Travel Trust owns it. I'm going to try to talk about it tomorrow when I do my conference call. It is an embarrassment. I do believe that the stock is cheap. That's not been enough so far. I am not throwing in the towel, but I am aware, as you are, that this has been a bad stock pick. I listened to Bob Backus the other day with David Faber. I thought that David was tough on him. Dave just said he was fair. I agree. Richard in Washington. Richard!
Hey, booyah! Hey,
booyah.
Jim. So with Ferrari, the ticker number race buyback program and their third quarter results indicating like a 9% up in revenue and like their 0.3% net in industrial debt. What do you suggest with this stock? Is it a good buy or a hold?
And that is Ferrari. I think it's a very good situation. You know what? I liked this one at the beginning, and we caught a double, and then I walked away, and that was wrong. This is just a very steady, solid situation. I know the company. I've done a lot of work on it since I initially went to work on it, and I think the world of it. I think it's very good. Bill in Kentucky, please, Bill.
Hello. Thank you for taking my call.
Of course. Thank you.
I'm just, I want you to get my back on something. I immediately bought Charles Schwab shares on October the 1st when it was announced that they would give away free, it would be commission free,
okay,
not cost free. And then A few weeks later, I sold 1/5 of them at a very nice profit, and still had the same amount that I originally invested. But now it's almost the middle of December, and they've gone nowhere. Should I sell the rest?
No, it's digesting what's going to be a great move. I think it's a terrific 2020 play. I would stay long. Why? Not because of the brokerage business, but because it's tremendous asset gather, maybe the best in the business. Marco in Florida. Marco.
Hi, Jim.
Marco.
Back in July, you recommended Diamondback Energy. You said it had way more room to go. I bought it at 106.75, and I have a loss of 21%. I was wondering if I should sell it or hold it.
No, I've been wrong on the energy stocks, as I mentioned, and you'll hear from me later in the show again. I was too bullish about energy. I thought that they would bottom, and that Diamondback Energy had the best growth characteristics. That is some degree true, but my bullishness in oil was incorrect, and I got it wrong. Sometimes you get it wrong. I got oil wrong, and I'm not going to stop beating myself about it because I should have realized that the group is just not that good. All right, strong themes propel strong stocks higher. And right now, we need apolitical themes that work no matter what. Oh, man, money tonight. Which sectors are positioned to roar in 2020? I'm going off the charts to find out. Then, Yeti has certainly cooled off over the past few months. But could big coolers still mean big bucks in an uncertain market? I'm eyeing the company's potential. And missed last night's Eagles game? Nice win. I don't know how you could, after all my tweets. I'm eyeing the company that makes the connection possible. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.